Hey, what's up, good people? How you doing? Hey, this is Larry Jones back with you. For those of you that's new to this page, go ahead and click that like, subscribe, and notification bell. Those of you that's been rolling with me for a while, go ahead and hit the like button. It helps to keep your boy alive. First, I want to talk about Webull. Webull is a trading platform. I have a link below. If you click my link, it helps the page. But it is a great trading platform. They have fractional shares over there, pre and post market trading. So click the link below and just check out all the links. I'll talk about some more at the end of this video, but let's get right into it. I have a special guest. This is mi corazón, mi heart. This is my good friend, Eli Rosario. He is a certified CPA. He's going to explain what that is. But for those of you that saw an earlier video, that was his son. He was the best man in my wedding and one of my closest friends. So welcome to the show.
Thank you.
All right?
My brother.
Hey, today we're going to talk about taxes on gains, all right? And so first, introduce yourself.
Yeah, my name is Eli Rosario. I'm a CPA. That means Certified Public Accountant. I know you guys know about the accountants. I'm your guy. And so
AKA Rico Suave.
Rico.
So let's start off with what is capital gains?
Sure. You know, capital gains is really the sale of any asset. Sometimes, especially for investors, you think that it's only related to the investment account, but it's the sale of anything. Property, real estate, it could be a boat, it could be, a vintage car, artwork. But what you guys are literally interested in is how does it affect your investment accounts? Capital gains actually represents the gain that you get from the cost minus the sale of an asset, or in this case, a stock. It could be crypto, it could be any type of stock. And that net gain represents capital gains. And
so the net is what you keep.
It's what you keep.
What you made, not your initial investment, but the gains that you made off of your profits, correct?
That's correct. So it's the cost of the stock, also the commission that you expend on that stock, and then it's subtracting the sale less any commissions, and that net number is what it is. That's what represents capital gains for you.
How much taxes do you have to pay on long-term investments, right? So let's deal with long-term and then we'll get to short-term. Number one, explain what is a long-term investment and then explain the taxes on it.
Sure. Yeah, long-term is actually really easy. It's anything over 12 months. So if it's 1 day over 12 months, that is long-term. That's from a tax standpoint. So when you think about long-term capital gains, the way that they're calculated is we talked about gain versus loss, and so you get that overall gain. But the long-term side of it is actually taxed in 3 different ways. You pay 0 tax, you pay 15%, or you pay 20%. And the way that it's calculated can be actually quite simple. If you want, I'll explain it.
Please do.
So,
Please do.
So look at
I'm
it.
here to help the people.
So look at it this way, as you know, from a capital gain standpoint, the things that are going to be relevant to you is how long have you been in an investment, is what is your tax bracket or your income level, and it's also whether or not you're married filing separate, married filing joint, like your marital status, or whether or not you're a head of household. Those things are going to affect your tax itself. And so when you look at long-term capital gains, they're going to be taxed based on those variables. Really simple example. If your income for a single person, right, if your income is between $0 and $40,000 on an annual basis, you're going to pay that 0% on the long term. If you're between 40 and let's say 440,000 or so, this is about 2020 tax rates, you're going to be in the 15% bracket. And if you're over 440,000, then you're going to be in the 20%. And that's how you calculate the long-term capital gains tax. It's also will vary based on whether or not you're married filing joint, married filing separate, or head of household.
Wow. Okay. The flip side of that, explain what short term is, and then the taxation on that.
Yeah, short term, is obviously the direct opposite of long term. It's within 12 months, right? So the day that you purchase versus the day that you sell. If it's within 12-month period, then it's short term. The tax rate on the short term is based on your ordinary income. So whatever your tax status is, that's what you're going to pay based on any gains that you have in a short term standpoint. It's important to note, right? When long term, you know how you get that zero tax between 0 to 40 for individuals. For short term, you're going to pay tax, right? It's going to be something like 10%. It could be 12%. It could be 22, 24, 32, 35, 37, depending on where you are in that scale.
Mm-hmm.
And that's how short term is calculated.
So day traders and swing traders are going to pay higher taxes than someone that has an equity and holds it for 5 years.
That's generally yes, right? But,
yes.
But then you can be strategic about it. You can do different things to offset it. But it is based on whatever your income is.
Name one of the things that we can be strategic, just like the wealthy, and offset the gains. Go ahead.
Yeah, I mean, so obviously there's capital losses that can be incurred as well, right? You have capital gains, those same transactions can generate a loss. And so if you take a loss and you offset it against the gain, you actually, at the right time, strategically, you can actually reduce some of that impact. And, obviously the issue of deciding when something is long-term versus short-term can make a big difference in your tax bracket.
So that was my third question was, is it ever a good idea to take a loss for tax purposes? And so you hear a lot of people talking about that, but most people don't know how to successfully do that. And that is, you're hitting the nail on the head, when and what type of stock, like a short-term and long-term. You have to see which stock you've had over 12 months and which stock you've had under 12 months before you take a loss for tax purposes. Can you expound on that just a little bit more?
Yeah, so, capital losses are actually pretty cool. Remember earlier I told you capital gains apply to other things as well. And so let's just say on your tax return you actually have some form of investment gains. Maybe you have a capital loss that you can use to offset even investment gains in your stocks. And so there's great strategy available for capital losses. Here's the thing. You can offset a capital loss against a capital gain even. So if you have $100,000 worth of capital gains and $100,000 worth of capital losses, you can wipe them out on your tax return. If you have a loss beyond, so you're $105,000 against $100,000 of gain, you only can take the $3,000 additional. So you can take $103,000 worth of capital loss in the current year, and then the remaining two that I mentioned, right, 105, you actually can carry those over into future years.
Wow. That is really cool.
Yeah.
And so this is what wealthy people do. You need someone that knows the rules and the laws of taxes, because you think you're saving money by doing your own taxes. You're actually costing yourself money. And so let the professionals do what they do. And that's one of the things that I was bringing these things out, because we want to have the same write-offs as the billionaires. I have a playlist that this will be added to. I think I'm going to just call it Investment Fundamentals. So look down below on the page. It's going to be called Investment Fundamentals. I'm going to be talking about, you're going to look down there, you're going to see Roth IRAs, which his son covered. You're going to see investment funds, ETFs, mutual funds, index funds. All of these type of things will be in that list. All right, good people. We're going to keep this one short, right there, right to the point. Hey, I want you guys to share this with as many people as you can, because we're trying to get this knowledge out there. I'm going to be doing more of this. I'm going to have this gentleman back, and I'm going to start a secondary page. It's going to be called Larry Jones TV, and we're going to help you guys build your businesses, give you business ideas. It's all going to be positive. You guys know I'm a spiritual person, so you're going to be getting some spiritual me, and I'm just going to be me. I'm going to do a little music on there. I'm just going to allow me to be me. But we want to help invest in you and not just your bank accounts. Anything you want to say in closing?
No, I mean, this is my brother, so I'm excited about what he's doing. He's changing lives, and he's really making a difference. And so I hope there's a way to answer some of your questions, to provide any answers to it. Reach out to Larry. Larry, reach out to me. I'll be happy to share additional context.
There you go. All right, good people. You know what we want to talk about is wash sales on taxes. Mm-hmm. You want to cover that later on the next one, or would you want to just expand on that?
We can talk about it, right?
Want to talk about it now?
Sure.
You know what? For those of you that's investing and you buy an equity, you buy a stock, and it drops in value, and then you sell it the same day or the next day, and then you buy it back in and you see that W, that's a wash sale. So explain what that is.
Yeah, so we talked about capital losses. When you actually do a sale, it turns into a loss, and you're using and trying to get the tax benefit of that loss. It can be offset if within a 30-day period you turn around and you buy that transaction again. In theory, that's a wash sale. And so the IRS doesn't want you to take advantage of that tax benefit and then turn around and buy the asset at a really low price. So what it literally does is those sales offset. They literally wash themselves out. You will not get that tax benefit.
And exactly. And so let me explain this. Let me add to that. So a lot of you, and if this is helping you, leave me a comment. A lot of you will see, let's say you buy something for $10, right? It drops to $8. And then you sell it, you're like, I'm cutting my losses. Then you go, wait a minute, I want to get back in the next day, right? And so you buy it again, and you put a limit order to buy it at $9. Let's say it dropped to $7, right? You bought it at 10 and you sold it at 9, it drops to 7. And you put a limit order to buy it at $7 and it fills. And you think you bought it at $7. But when you actually look, you actually bought it at a higher price. And that's what it does now for the tax sale. And you get for the wash sale. So you think you bought it at a lower price. It actually goes, nope. Just like he said, you can't buy it back at this price. That's a wash sale. We're going to fill your order, but you're actually buying it back at a higher price. So a lot of people have been seeing that and they're going, wait a minute, what's going on? That's part of the wash sale, right? And,
30 days.
30 days.
30 days.
So what you have to do is wait 30 days and then rebuy it. Okay, so there's a lot that we need to know. We are not going to just load up the boat here. We're going to balance the boat, good people. I'm going to cut it off.
Can I share one more thing?
Please, go ahead.
Before we're gone, you know, we talked about capital gains, but it only applies to taxable accounts, right? Capital gains don't apply to things like IRAs, any of those non-taxable accounts. So it is relevant for you to know that as you consider, the implications of taxes.
So I'm going to leave a link. Where am I? Right here. I'm going to leave a link right here. And his son is talking about Roth IRAs. If you're listening to me, I don't care if you're 18 and you don't have a Roth IRA, you're missing out. All right. Everybody over the age of 18 needs to have some money in a Roth. I'm going to leave that video right here. Forgive the buzz. I got the audio fixed now. I'm going to leave it right here at the end of this. I want you guys to watch it because it's going to help you guys. All right. I sound like a Baptist preacher. And in my close, so I am going to close it out right here, good people. But this is great information. Please leave me some comments if this has helped you. And hit the like if you haven't, because this helped to get it out. Share this with your kids, your sister, your Jethro, Tyrone them, Day them, LaQuisha, Jorge. Share it with everybody. And let's get this information out there. Also, too, in leaving, if you're getting into crypto, I have 2 links below. One is BlockFi and the other is Coinbase. Download them both. Put $100 in both of them. Even if you don't know, just get ready. You don't have to make any purchases and learn about crypto, because there's a ton of money, a fortune to be made in crypto. All right, I'm going to leave it right there. All right, can you sign it off for me? Live, love, laugh, and learn.
Live, love, laugh, and learn.
We'll see you later. Peace.